Now it's starting to look like the IMF, the BIS, they're getting a little nervous about cryptocurrencies because there was a high-ranking official at the IMF, and this individual is urging central banks to develop better fiat currencies in order to maintain their leadership pace over cryptocurrency. Now, this is the IMF Deputy Director Dong He. He makes the case that crypto assets may one day reduce demand for central bank money, and that the government institutions must do more to not to let this happen. In other words, to forestall the competitive pressure crypto assets may exert on fiat currencies, central banks need to adopt some of the core concepts driving digital assets. So at this time, we can see the central banks, they realize if the people understand what cryptocurrencies are, and people start moving away from the fiat system over to cryptocurrencies, they are in big trouble. And they're saying that central banks must maintain the public's trust in fiat currencies and stay in the game in a digital sharing and decentralized services economy. Now, once again, their system is not decentralized. Their system is centralized. They can't compete with the decentralized system because they need to have full control over everything. They need to have the control of the creation of the currency. And with cryptocurrency, that's a little bit more difficult because it's not the central bank that is creating it. It's miners around the world that are creating the cryptocurrency. Now, if they get their hands on having the cryptocurrency and the governments pass laws, which, they can try to force them to do so. They did this back in 1913. They bribed and they did whatever they had to get their fiat currency into the system. They might try the same thing. But if the entire economic system crashes, who's going to believe a central bank? Who's going to trust a central bank? Because the world will then see that these central bankers have put countries into debt and imploded each and every one of these countries. And if we go back in time, we will now learn that they have lied to us during each downturn of the economy, because they tell us that everything is fine, and then everything starts to fall apart. And once we audit the Fed, what do we find out? We will find out what they've really been doing. Remember, they're not transparent. Even though they're telling us they're transparent, they don't want anyone seeing the inner workings of what they're really doing. And they're very afraid of any other type of system. This is why they've been manipulating gold and silver, because they don't want people to realize that gold and silver, that's the real money. That's your insurance policy. And they've done this for many, many years where they suppress it because they don't want people looking at it. Because if they just let gold and silver do what it does normally, gold and silver wouldn't be at 1,300 and change. It'd be much, much higher because the value of the dollar has decreased. Currencies around the world have decreased. And what that means is, well, gold moves up in value. We've seen it throughout history. Now, the Central Bank of Russia, they're saying, well, crypto assets, they do not pose a risk to global financial stability. They're saying because right now, cryptocurrencies, the market is very, very small compared to the global economy. And they're saying there's really not that big of a worry. Now remember, Putin came in and he took control of the private Western Central Bank in Russia. They're pretty much debt-free in that country. They call the shots. It's not the Rothschilds. This is why they demonize Russia so much, because they do not like what Russia did. Same thing with other countries that do not have the central banking system. And we see at this time, they're saying, yeah, cryptocurrencies, it's a good thing. And it looks like they're creating legislation to regulate, to make sure that people don't get hurt with cryptocurrencies. And they're taking the crypto market and integrating it into their system. Same thing with China, same thing with all these countries. Eventually, all the countries are going to come aboard the cryptocurrency market. And they're going to allow the people to use it to purchase, to get paid in. And we're already seeing this happen, and this is just going to grow. And it's going to get larger and larger, because what is happening right now? The entire economic system is falling apart. It's crashing. We have too much debt, and we need to transition into something else. Now, we can either transition into a central banking currency, or we can transition into a people's currency. And I would like to see us transition into a people's currency where we don't have the central banking system. We don't need an institution that is private controlling the currency and the economy. We don't need it. It's not necessary. Never needed it. The central bankers tell us that we need them. But if they're telling us we need them, we really don't need them. Now, out in the UK posted the worst GDP figures in 5 years on a weak business investment and housing and household spending. The country's all-important housing market, well, it's beginning to show signs of a huge amount of strain. And in April, the house sales were down by 9.4% on the previous year. In the UK's most valuable market, London, house prices had their worst month since 2009, slipping 0.7% according to the latest figures from the Office for National Statistics. Now, on credit demand slips, some banks have decided to bring back a financial relic. And every time banks start opening it up to subprime individuals, giving 100% mortgages, or giving you 3% down with no income check or anything like that, you know we're approaching the end game, and they're becoming very, very desperate. And this is what we see happening out in the UK. And they're bringing back this financial relic that should never have seen the light of day in the first place. 100% mortgages. Both Barclays Bank decided we're going to do this. And the privatized post office, they recently unveiled 100% mortgage deals. Now, mortgages for 100% or above of the purchase price not only help fuel octane housing bubbles, they also make them a lot riskier when home prices decline. And when more and more borrowers end up with negative equity, where someone's home is worth less than their debt, that in turn significantly raises the likelihood of borrowers defaulting on their loans. And that's why these 100% mortgages are very, very risky for the banks. Now, today's new breed of 100% mortgages, they have a little bit of a twist to it. And what this twist is that the banks need extra security. So they're dragging in family members acting as guarantors for parts of the loans. In other words, if a borrower falls behind on the repayments, a parent's home can also be put at risk. So what's happening here is the mothers and the fathers, they are backing these loans to get the 100%. They have to put their houses up for collateral. And if the children lose their jobs or they can't pay the loans, then all of a sudden their house is at risk. And this is going to be a complete and utter nightmare. And how widespread is this? Well, parents helped provide deposits for more than 298,000 mortgages last year. That's equivalent of 26% of all transactions. And this year, they're expecting this to go even higher. So basically, more than 1 in 4 transactions in the UK's property market this year will depend on the bank of mom and dad financial support. This is going to be a complete and utter nightmare because we see housing bubbles in the UK, in Australia, in Canada, and here in the United States. And this is going to have a domino effect, and it's going to run rampant throughout the economy. It's going to be absolutely awful, especially when the European nations, their youth unemployment right now is very, very high in 11 of the EU nations. I mean, this is just a recipe for disaster here. And they're fueling this by bringing in subprime, 100% mortgages. The interest rates are rising at the same exact time. I mean, this whole thing is going to be a complete and utter disaster. Here in the United States, the employment numbers came out, and they're trying to convince us that we are looking pretty darn good. I mean, the unemployment rate came down to 3.8%. This is 18-year low. They're telling us that we're in full employment right now, and everything is fantastic. But when you really look at it, we know that these numbers are fake, phony, and false in the first place. We've gone over this many, many times. The calculation has not changed whatsoever. They're still doing the same exact tricks. There's no difference here whatsoever. And we could see that the labor force participation rate, well, it hit an all-time high, 95.915 million. And this is continually moving up and up and up and up, which means there's a lot of people out of the workplace. And adding this to the 6.1 million currently unemployed Americans, there are about 102 million Americans who are either unemployed or out of the labor force completely. So basically what they're doing is those people are no longer looking for a job, so we're just not going to count them. And we're just going to keep lowering the unemployment rate. Now again, we have to look at these numbers and really think about it. Well, if this is truly the case, and they're telling us that we're at full employment, we're at 3.8%, why aren't the wages going up? Because there's a shortage of workers. We can't find anyone to fill the jobs because we're at full employment. So they should be offering a lot more money to fill these positions, but they're not, which is kind of odd. Same thing with why are delinquencies on the rise if everyone has a job? Why is retail suffering right now if everyone has a job? And we discussed the brick and mortar and online sales and all that other stuff. There's a disconnect here. The disconnect is that these numbers that they continually feed us, they're manipulated, and they've been manipulated for a very long time. Now, we see that Deutsche Bank, they have a huge amount of problems, and already, what do we see? Well, they've been placed on the list of the Fed, which is secret, where they're saying that Deutsche Bank is a complete and utter disaster. S&P, they've downgraded Deutsche Bank to BBB+, and they're 3 notches away from junk. And you can see that Deutsche Bank is getting hit hard right now, and this is going to spread to other banks. The Italian banks are in trouble. Deutsche Bank's in trouble. Many other European banks are in trouble. Spanish banks are in trouble. They're just trying to hold all this together with spit, tape, and glue here, and it's falling apart all over the place, and they're just trying to make sure that the whole thing doesn't fall apart because they will lose control. It will spread to other countries because they're hooked through derivatives. It is a complete and utter nightmare. And we know we're getting to a point where this whole entire system is going to come down, because we talked about this before. Bank of America, they came up with this bear market indicator, and we've seen their indicators, and they've called it time and time again when the market has come down. Now, let's go back a little bit in time here towards the end of January when they were using their new bear market indicator, and everything was at the highest point that we've seen, and they said, well, there's going to be problems. The indicator predicted not only the size of the upcoming drop, which was minus 12% on average, but also the timing over the coming 3 months was right on. Also notable, its uncanny accuracy was correct on 11 out of 11 previous occasions after it was triggered. And this is what Bank of America said. Bank of America bull and bear indicator surges to 7.9, highest since sell signal greater than 8 triggered March 13th. Bank of America bull and bear indicator has given 11 sell signals since 2002, hit ratio 11 for 11, Average equity peak to trough drop following 3 months equals 12%. Note that the last bull and bear indicator flashed was a buy signal of 0 on February 11th, 2016. So fast forward to today, when the bear market is that much closer, according to the Bank of America reports that as of this month, another 2 indicators, they've been triggered, meaning that 13 of the 19 bear market signposts are now flashing red. So we are more than 2/3 of the way to the next crash, depression, recession. And when you look at this and you look at the bear market signals when they were triggered, we can see it. It was right before 2008. It was right before 2000 when we had these recessions, and we go back in time and you can see that when they calculated backwards, it was triggered every single time. And here we are again. We're reaching that point where it's going to be triggered, and every time we speak, there's another trigger being added, another indicator being added to this. And we're getting very, very close to when all of this is going to start falling apart. And this can accelerate at any time, because we already see signs out in Europe that things are completely breaking down and they're not going well. And if Deutsche Bank continually slides, I mean, we might see a bail-in, we might see a bailout. We don't know. And the ECB is watching all this. They know there are problems, and I think behind the scenes what they're doing is they're trying to control the situation, even though they're out front telling you that everything looks great. No, that's not the case. They always do things behind the scenes to try to minimize the damage, just like going back to 2008. What was the Fed doing behind the scenes with Bear Stearns, with AIG and all the rest? They were already planning on giving them bailouts. Actually, they probably funneled them funds already to try to stop what was happening, and then it got completely out of control, and the whole thing started to spiral downward because it hit other things in the economy, and everything started to fall apart. And I think here we are once again. We're starting to see the same thing, but what we're seeing is it's happening in other places, and it's going to spread just like it did back in